You must build up your life action by action and be content if each one achieves a goal as far as possible. And no one can keep you from this. But you say, there will be external obstacles. Perhaps, but no obstacle to acting with justice, self-control, and wisdom. Welcome to the show dedicated to helping you not just survive retirement, but to have the confidence, because you're doing the work, to lean in and rock it, to build that life up, action by action. Today's show is going to be a little bit different. It is born from a number of conversations and interactions I've had with clients, Rock Retirement Club members, as well as people like you listening to the show that email me and reply to our Noodle email every Saturday, which you should sign up for, by the way. We're going to share some resources to help you on the topic we're going to talk about today. You can sign up for it at thenoodle.me. It's our weekly email where we give a summary of the show and share resources. If you hit reply, it actually comes directly to me. So if you want to tell me something, that's an easy way to do it. But we're going to do a deep dive on, is your retirement safe? And how do you navigate financial security in uncertain times? It's going to be some wise words, hopefully, from my experience, as well as practical steps you can take. Our intent is to help reframe how we're thinking about everything in the world today and how to take action that is productive for you. After that deep dive, we're going to share some rocking retirement in the wild stories from listeners taking action on creating a great retirement. After that, I'm going to do something I don't do very often, but I think might be helpful in this moment, is to tell you a little bit about myself and my origin story. Not something I'm super comfortable doing, but it's very easy to sound smart on the internet or in front of a microphone. It's just super easy with AI, etc. So I want to give you some perspective of where I speak from, and you can make the decision whether it's helpful for you or not. Then we'll always end with a smart sprint and a segment from my grandfather's journey in World War II. So let's get this party started. All right, deep dive on navigating retirement in uncertain times. Here's how we're going to approach this. Number one is I'm going to set the stage. Two is we're going to talk about a little bit about some of the worries. When we're worried, some of the dangers that creep up when things are a little bit scary. Then we're going to go to the risks that are there if we act inappropriately. Once we do that, we're going to pivot to what should you do now? What should you do to have some control over your retirement plan and build up a life action by action? Incremental progress always. Now, I think I need to give a warning here because we're going to talk about some things that are in the political realm. Yes, we are. And when we have a retirement planner hat on, you shouldn't care about my political views. And honestly, in that realm, I don't care about yours. So we're not going to talk about our opinions on things, but we're going to address some of the things happening in the political world right now and how they relate to us in retirement planning. So just be prepared for that. All right. So let's set the stage first. For decades, 40, 50 years, as long as I can remember, national debt has been an issue. Budget deficit has been an issue. Trade deficit has been an issue. Immigration policy has been an issue. Waste in government has been an issue. The feasibility of Social Security long-term has been an issue. Same with Medicare. The protocol seems to have been over the last 40, 50 years is that we talk about these things during election periods. Our leaders say they're going to address them. And then once they're elected, maybe we take some incremental action, but nobody can agree on anything. So we just go about the business of prosperity. And then until the next election cycle where we talk about them again. That seems to be the protocol, but we all know these things are issues that need to be dealt with that, like a cancer, have been growing at various rates over time. Well, this current administration that came in January doesn't seem to want to play by that protocol. They appear to have a shock and awe protocol where they're not going to play by those rules anymore. They're going to reset and actually try to address them. Now, let's assume for this moment that they are sincere in what they're doing, because we don't need to get into that discussion. Let's assume they're sincere. They're using a shock and awe strategy with Doge and tariffs and immigration policy, etc. There's a lot happening really quickly that it's very difficult to keep up with. And on all these topics, my guess is that you have some opinions on immigration or Doge or waste or tariffs or whatever. I have opinions. My guess is you may have some convictions about a few of those that you're passionate about. Myself as well. In our political lives, that's a great place to express those. We support candidates. We communicate with leaders. We fund causes we believe in to try to help create a better country, maybe even march at times. Who knows? In the political realm, that is our role. But, and this is my point, when we have our retirement planner hat on, which I have on when I talk to you on the show, or when I'm working with a client or teaching in the club, when I have my retirement hat on, what my opinions or convictions are in those realms really don't matter. That's not my role. My role is to help someone else build a great life action by action from a retirement planning perspective. Now, my role isn't to put my opinions on what I think is going to happen or what should be done. It's not my place. When you put your retirement planner hat on, when you're thinking about your retirement plan and navigating, I would suggest to you that you should put aside those strong opinions and convictions as best you can so you can focus on building a great life step by step. When we let those things bleed into our retirement planning role, some really uncomfortable or bad things could happen. We essentially have a choice as a retirement planner every day, is you can feel acted upon because all of this craziness is going on and the shock and awe, and the rules may have changed. Who knows how long this lasts? You can maybe feeling acted upon just like we would when we get cancer or we get ill or life happens to us in the non-financial realm. You have a choice to make. You can feel like you're a victim and I'm powerless, or you can try to grasp for what can I do to build up my life action by action, as Marcus Aurelius says. That's what I want to focus on. The central question, I think, when it comes to all the worries and uncertainty right now is this a means to a better end, or the end of life economically and financially as we know it? That seems to be the central question about the shock and awe approach that's happening. Because the pace of change is frightening. That creates that fog that I've talked about that comes in where we can't see the future near as well because all the rules seem to be changing. And we don't know what is speculation, what is truth, which just confuses the whole situation, which causes uncertainty and markets go down and all sorts of things happen. So those are the worries. So now what are the dangers that happen during this type of environment? Well, one of the dangers is that we bask and bathe in this worry, and it gets exacerbated by the media because they're incentivized to amplify fear and uncertainty. Essentially, the media and the internet in general is a mechanism to amplify whatever we're feeling, whether it's greed or fear. And right now, fear and worry is the main topic for a lot of us. So the media and the internet amplifies that to their ends to gain viewership and sometimes to sell product. That's a danger. We got to manage that. We got to limit that. Another danger is we just have too much information. We're aware of way too much. I went to CNN.com, FoxNews.com, Apple News, and Wall Street Journal and just perused the headlines. And here's what I found in like 5 minutes. Children dying in Ukraine with photos. Hamas and Israel firing missiles back and forth at each other. And I think the death toll is over 50,000. There was a headline. People at car dealerships burning cars and shooting dealerships. Town halls locally erupting and caught on video. I saw a headline on one of the financial presses where it was like, there's a danger zone for retirees when the markets dip, expert says, with exclamation points. We can watch murder trials all over the country with commentary. We are not equipped to absorb all of this that just keeps coming at us, and it puts us on our heels and makes us fearful. That's the danger here. Another danger is for you and I, if we're near or in retirement, this can get exacerbated because retirement, this life change, is one of the top 5 stressors, I believe, in life, heightens all of this worry about the future. We're losing some of our superpower to work and earn money, which feels powerful. We can dig our way out of it. We're losing that. And that's puts us on our heels a little bit. We're facing the fact that, wow, like Roger here is 58 years old. I'm getting older. I'm feeling it. I'm seeing it in the mirror, and I can see the future, and not all my life is symmetrical. That's scary at my weaker moments. So it puts us more at risk here. And then lastly, the danger is, right now with fear, but it works with greed too, is our hucksters. The hucksters are out there. Now, huckster isn't a bad word. It sort of has a bad connotation, but I looked it up. It's one who sells wares or provisions in the street. Okay, that's a definition. A peddler, a hawker, one who uses aggressive and showy and sometimes devious methods to promote or sell a product. Yeah, I could see that. But a huckster is someone that just sells wares, usually in the street. Hucksters are dangers to us when we're fearful or when we're greedy. And I'll give you a couple examples there. One is from a financial services standpoint and financial planning standpoint, the origin story of the financial services business is a distribution machine. We have huge financial firms that create product, either as advice or as actual product, like mutual funds or insurance products, etc. They hire advisors, some that are advisors, some that are salesmen, some that have financial planning background, but to distribute not just financial advice, but the products that are created. This is just the nature of it. I'm not even saying good or bad. But what happens when you have a factory? You respond to demand. And I've seen this over and over again, not just in financial services, but financial planning. In the 1990s, it was greed that was the dominant emotion. It wasn't fear, it was greed. It was, we're a new economy, the internet has been born, technology revolution, old rules don't apply. Making normal returns isn't good enough because I can make double, triple, quadruple returns in internet stocks and technology. And that was the craze that a lot of us, if you're my age, vintage year or older, remember. And so what did the production factory do? They created things like MunderNetNet, which was a mutual fund. I don't even know if it's still around or not. I did a little basic research just to get some numbers. I remember this fund. I probably owned it at one point. Well, first off, MunderNetNet was a mutual fund that focused solely on internet and technology stocks in a very aggressive way. So that's what it was. In 1997, a year after its inception, it had about 10 million in assets. And by April of 2021, I believe, it had up to 12 billion in assets. It had massive growth during the last throes of the internet craze of the 90s and had returns well over 50%, I believe. And it was produced because people demanded it, because they were greedy. And so the product market responded. And then when the internet bubble blew up, I recall, I don't know if it was the first one, but I think I was working at UBS at the time. I don't know if it was the first one, but I recall the introduction of a principal protected mutual fund. I think it was the first of its kind, but I don't recall. And the pitch was, you put money into this fund, you will get upside return, but your money is safe if you hold it to maturity. I think it had a maturity date. It had some weird thing. I don't think it worked out very well, but it was produced because people weren't greedy anymore. They were fearful. And these hucksters are responding to demand. And that's a danger for you and I, whether we're greedy or fearful. Right now, it's the fearful end of it. That's a danger of responding to just people trying to sell us stuff that are trying to alleviate whatever we're worried about. So the risk is acting on these dangers. So let's go to risk for a second. As you navigate building a great life step by step, Our risk is how we act on our worries and the dangers that exacerbate those worries. So if we take two extremes, one is to just put our head in the sand. Everything will be fine. I don't need to pay attention to any of this. There's some value to that, but then that diminishes greatly. I saw this happen in the 90s where it was a new economy and people that just said, I'm going to get 20% a year and I'll retire and take 10% of my portfolio every year to live on. The numbers just work. I did a spreadsheet. I know really smart people that did spreadsheets like that, actually retired. And then when the internet bubble burst, they doubled down or ignored what was happening. And they just kept taking the same kind of withdrawal rate. They had their head in the sand and ended up in really bad situations with a lot of bad choices. So head in the sand is generally not a good strategy. Now let's go to the other extreme, which is extreme action. Whoa, we start to let our convictions about what's going to happen in the future and our opinions bleed into our retirement planning realm, and we act on the worst fears that we have. And I have numerous personal instances of navigating with clients these type of actions. I saw this happen in 2008. We're coming out of 2008 and 2009. The financial system was almost blew up. Literally, it did. Any analyst would say, I don't know how any of this works out. And there were clients that wanted to take extreme action, assuming that it didn't work out. And what ends up happening if you follow that thought process is you end up painting yourself into a corner that you better be right that the extreme outcome of the financial system as we know it actually blowing up, happening, it has to happen. Not only does it has to happen, but your timing better be right too. Luckily, we were able to navigate away from extreme positions because a lot of people gave up on finance, gave up on markets, gave up on everything, and missed out on the fact that there were a lot of vested interests in keeping the party going, regardless of what made sense or not. We also saw this during COVID, global pandemic, bear market. We saw this with Y2K in a lesser extent. So extreme examples, that's not helpful either. Incremental actions where we have our planner hat on and we're trying to think logically so we can build step by step. We need to be nimble. I would argue we need to be agile and work off of what is actually true as much as we can and give ourselves a lot of flexibility. All right, now let's pivot to, okay, great, Roger, you set it all up. What the heck do I do? That's really one of two questions that are the most important questions before the house always. Am I okay? What should I do? We can talk about our opinions and our convictions and all the worries as much as we want, but at the end of the day, it comes down to, am I okay? What should I do? And where should our focus be there? Well, I'm going to tell you first where our focus should not be, where your focus should not be. Your focus should not be what's wrong or right. That has nothing to do with building a retirement plan you can have confidence in. It doesn't have anything to do with what our opinions of the future is going to be and trying to predict how the dice are going to roll, because this is not predictable. We're not going to focus there. What we're going to focus on is, what can you do right now to improve your situation and to have some control over all of the uncertainty in our lives? External uncertainty and internal uncertainty. What can I do next? And that's a loop we want to get into. Okay, this is where I'm at. What can I do? What are risks and opportunities that are presenting itself? What is the most important ones? Okay, let me take action on that one and then celebrate the action and then go back through the loop again. Now what? Now what? Now what can I do? Now what can I do? Incremental improvement is where it's at when it comes to retirement planning. Not trying to be right and be smart and to paint ourselves into corners. That nimbleness, that agility that is going to help you build up your life action by action. All right, so we're going to get to more specifics here, but we're going to do it for two different groups of people, because this is literally what I try to talk about and teach on the show every week. So we're going to first talk to the crowd of people that have a retirement plan of record. What should you do? And then we're going to talk to people that maybe haven't gotten around to it yet or haven't finished it yet. And what should they do? Okay, so first we're going to talk to people that have a retirement plan of record. So what is that real briefly? That is, they know who they are and what they want, and that is expressed in how much their base Great Life costs and what the discretionary spending wants are. They have that mapped out in some version, knowing that it's imperfect. Secondly, they have organized their resources, their social capital, their human capital, and their financial capital, and have assessed that with the levels of resources they have, given their spending over their lifetime, they've assessed that it's feasible using typically software like Monte Carlo scenario software or spreadsheets or something like that. They've assessed long-term, this is a feasible path for me. And then lastly, they've built out a resilient plan where they have clarity on how they will pay for their life over, my default is the next 5 years. These things are in place. So that's what we're talking about when you have a plan of record, which is always changing. So what do you do if you have this plan of record in place and you're worried about how all this plays out? Well, under vision, here's what I would suggest you do. Number one, reassess your base Great Life spending estimates. And we're all on some scale of how detailed those are. Oh, this is just a guess for me, or I have Quicken data for 30 years. So right now is a good time to rekindle your campfire of confidence by, okay, here's what I need to spend. Let me put eyes on that again. If you're married and you're the financial manager, have both of you put eyes on that again. This is what we say we want to spend. And then look at your discretionary wants, the spice of life. Are these still relevant? Confirm those and update them. Now's a good time to refresh this if you're really worried. Anytime you're worried or facing a decision, it's good to go through this protocol. Once you have your spending estimates reviewed and updated, next is move on to feasibility. Refresh your plan of record. Update all of the asset values of your social capital, Social Security, your pension, your human capital, part-time work, if you're planning on doing that, etc., your financial capital, the current value of that, and do your feasibility assessment using Monte Carlo or whatever tool you use or have used to build your plan of record. Oh, yeah, I'm still feasible. Once you've done that, let's move to resilience. Stress test that plan. What happens if the markets go down from here by 20%, by 30%? How is the feasibility of my plan if I lose 20, 30% of my assets? Is my base Great Life and my wants still feasible, or are my wants a little bit more iffy, but my base Great Life is okay? Do some stress testing on that. Do it with Social Security if you're worried about that getting cut or means tested. Next, under resiliency, reevaluate the minimum effective dose of risk you need to take. Now, this is easily done with software. I don't know about Bolden. I haven't used that in a while, but I know in the software we're using the club and in my practice, we can easily see if we're targeting a 60-40 equities to bond portfolio. We can see, well, what happens if I have a portfolio that's 80% bonds? Is my plan still feasible, even if I have much lower returns, but it's more stable? It's good to stress test what is the minimum effective dose of risk from a markets going up and down perspective that I need to take. It's not going to be perfect, but it'll give you a sense of maybe you're taking too much equity risk, even though you don't have to. Not perfect, but it'll help tease out a discussion of, do I need to take this much markets up and down? A lot of times we think that we need to because we need the returns, but in retirement, what happens is the consistency of return becomes more important and the average rate of return becomes less important because of how sequence of returns happen. So it's good to explore this. Next, revisit your RISA profile. The reset profile, we'll have a link to it in the noodle, is a profile that tries to match your withdrawal strategy to who you are and what makes you comfortable. It's not perfect, but it helps inform, are you more optionality based or more safety first based? Maybe you thought you were more optionality based and you were comfortable with markets, but now that we're under stress, you're realizing maybe I was more safety first than I remembered. That can help you identify maybe you have a mismatched strategy relative to what makes you comfortable and confident to retire. Good to revisit that. Lastly, and from a triage perspective, most importantly, and we talked about this on shows, I think in February, is update your allocation study. Specifically, do you have enough liquidity in retirement, or if you're close to retirement, for those first years of retirement, to fund your paycheck, which pays for your life for at least 5 years? Do you know exactly where that money is going to come from? And do you have confidence that it's not at risk of losing money in the markets? That goes a long way when you're under stress. So that is the protocol to refresh your confidence on your plan. And as you go through this, you will identify maybe little baby action steps you can take to improve your plan. If you are really worried about the future from your opinion standpoint, well, you can take incremental action to maybe build out your income floor and go from 5 to 6 years. Or you can go from 5 to 6 years and lower some of your discretionary spending, which actually makes it 7 years, knowing that this is just a season to help you have more confidence. Those are the kinds of things you want to tease out as you follow the protocol. That is if you have a retirement plan of record fully implemented. Now let's switch gears to those of you that don't have a retirement plan of record either fully implemented or any plan at all that is structured with the pillars of this is what I want, my vision, is it feasible, and is it resilient? If this is the case and you're losing confidence in your plan or lack of a plan or a plan that's not fleshed out as much, the key here is triage. Triage to give yourself time to do things a little bit more thoughtfully. Just think of like an ED or an emergency department. What do? When you come into the emergency room, as we think of it, they do triage. Are you bleeding out, or can you wait so we can prioritize who's most important? So they triage you to stabilize you so they can figure out what's going on and apply a treatment plan. Similar here, if you don't have a plan of record at all, or if you don't have one that you have confidence in that either you built or a financial planner built, now is the time to do some triage to get some breathing room so you can have a little bit of confidence and calm so you can build out your retirement plan of record. And the way triage works, it starts with liquidity. Start with your cash flow needs. So look at, assuming you're retired, or even if you're working, build out a 5-year cash flow statement as best you can of this is the income that I have right now. If you're working, that's work income. If you're not working, maybe it's a pension, maybe it's Social Security or part-time work, or maybe nothing. You may have nothing on the income end of it if you're retired. And then compare that for the next 5 years to what your expected spending is for your base great life and your wants. And if you don't have a plan of record, you might not have a good handle on these things. So a way to frame that might be, here are my fixed expenses and here are my discretionary expenses. Doesn't mean you have to go do a detailed budget, but you better get a sense of what you're spending over the next 5 years and whether you have enough income to cover it. And once you build out this 5-year cash flow statement, now you want to look at your income and say, how comfortable am I with those estimates? If you're working, I feel great about my job, been here for years, they value me. I put my job risk of losing a job at 5%. Okay, great. Have confidence in your income. But maybe you're in a position where, when markets are, going up, what's happening in the government, what's happening with the economy, My job's pretty expendable. My chance of losing a job is 80% or 70%. I don't know. Well, then that makes you aware of, this income I can't count on near as much. Make an assessment of those things, and that will inform you to make sure maybe I need to build a bigger emergency fund or contingency fund because my job is more at risk. Now, I didn't think so last year, but now I'm a little bit more worried. So maybe that is a sign to build some more liquidity as a shock absorber in case you lose your job. Or if you're retired, you're assessing Social Security, you're assessing your pension, which are probably fine. I think so. They're probably fine, except for rare cases on pensions. But maybe part-time work isn't going to materialize like you thought. Make an assessment of that. Look on the spending side and say, where could I cut back a little bit, which will help me manage the situation. But at the end state, you want to make sure you have a contingency fund, and you want to start building out an income floor if you need money from your assets to fund the gap that isn't covered by income. Sure would have been nice to have done that before markets started to be wonky. I think we're down. I don't know what we're down now. I think we're in correction territory. So sometimes we can feel like, I missed the boat. I can't do that now. I got to stay invested until markets come back. If that's what you're thinking, I would roll your horses there a little bit. What happens if they just keep going down? And number two is if you pull back the aperture and look at markets, sure, we may be in correction territory right now, depending on what market you're looking at, whether it's the S&P or the NASDAQ, whatever you're looking at. But if you pull back the aperture to 3, 4, 5 years, you still had a really good run. And it sure would have been nice to have the top, but if you want to feel more confident in your plan, maybe you can improve your liquidity right now, even though you didn't peg the top. Those are some basic things that you can do. But if you don't have a plan of record, do the triage. So none of these decisions that we walk through, whether you have a plan of record or don't have a plan of record, have nothing to do with what the government or companies are doing. They're searching for agency for you to take small actions to improve your lot. And once you find them, if things keep getting worse with markets or if the economy really goes into a recession, you want to incrementally make adjustments and be nimble, be agile, rather than make extreme decisions. Because we could be wrong. Things could go really well. And maybe this is exactly what we needed. Who knows? We don't have to have an opinion on that to build a great life action by action. Now it's time for retirement in the wild. Actions that individuals just like you are taking to rock retirement. Our first one comes from, and I think I said it would be anonymous because I don't have their name here. It says, hey, Roger, just a short note to say a heartfelt thank you for your podcast about a month ago on taking action now for a resilient retirement. I have a plan of record thanks to my work with you and all in the RRC. Awesome. And I had a plan in place with my financial advisors to shift the rest of my floor funding into safer investments as I'm retiring at the end of June. I reached out to them and they wanted to move the investments at the same time as the rest of the annual rebalancing that they normally do in April. After your podcast, I asked them to move ASAP, which they did. So I moved from probably an 80% equity to 20% bond ratio mixed into secure short-term bonds and treasuries in mid-February. The upshot, my floor funding is now much more secure and I am not freaked out by the 7 to 10% drop in the market over the past few weeks. Thank you for my and my husband's peace of mind. We recognize that more shocks will always come, but wanted to thank you for encouraging me to take action now. That is awesome to hear. And I would say for those of you who may not have taken action, take action. When it comes to the security of your retirement, confidence is really important, and having enough buffer to be able to react reasonably is worth it. It's not about optimizing returns. It's about giving you confidence to retirement. I'm so happy to read this, and thank you for sharing your story. Our next quick one on taking action comes from a new listener. It says, I found your podcast about a year ago and really enjoy your personality and all the great information. Well, thank you. That's nice to hear. I started listening to episodes from the beginning, kicking it back to 2014, such a long time ago. The 12, 16, 14 episode, we'll have a link to that in the show. I haven't listened to that in ages. Really stood out to me. It was basically stop watching the markets and live a good life. Your philosophy, although from 10 years ago, still rings true as we're watching the market take correction right now. I want to give you an attaboy for that. Well, thank you, but it goes to taking action, and you did all the action. I'm just the encouragement, hopefully. Okay, actually, we have one more, and this comes from another new listener. It replied to me from the Noodle, which you can subscribe to at thenoodle.me. We'll have a link to a resource I'm going to mention here. This person says, happy Saturday. Is there a table of contents or index that would make it easier for me to search for through your podcast? I'm interested in finding agency. I'm currently having scary moments thinking about retiring early at age 56, but still possibly doing some work related to the golf industry. Thank you, Dan. So Dan, understandably so, is a little worried. Retirement by itself in normal times is worrisome. It's scary, but when things are in turmoil, even more so. So Dan, I'm going to let Nicole answer this question in the Noodle this weekend. We'll have a link to a summary of a book called The Power of Agency that has a framework for finding agency. And then also, if Nicole is able to find a link or two to some episodes related to that, she'll have links to those in the Noodle as well. But thanks so much for your question and your encouragement.
On your marks, get set.
Now it's time to take a little baby step you can take in the next 7 days to not just rock retirement, but rock life. All right, I think we know what the smart sprint is. In the next 7 days, take some of the action steps that we talked about. Probably one of the, outside of the specific action steps of whether you have a feasible plan of record or not, probably one of the biggest action steps you take, if it's not those, is to start compartmentalizing your retirement planning so you have a process that focuses on agency and action rather than what is happening in the outside world. That's probably the number one thing that we can do to improve our decision-making when it comes to retirement planning. All right, now I want to share a little bit of my origin story. And the reason I'm doing this, I don't know the last time, I don't really do this, don't really have it much on the website. I hardly introduce myself at the beginning of the show. So you may be newer to the show, maybe you've listened for a while and it rings true, but it's good, I think, sometimes to reveal this. But it's a little uncomfortable, so I'm just going to try to give you some facts briefly. So from an education standpoint, I have a CFP, a Certified Financial Planner, got that in 2000. I taught the retirement planning segment of the CFP curriculum at University of Texas, Arlington to CFP certificates. So I've taught the curriculum. I have a CIMA, which I got in the 2000s, which stands for Certified Investment Management Analyst. It's through a great organization that I volunteer for, the Investment Wealth Institute. They partnered with the Wharton Business School and a few other schools. It's about basically portfolio construction from an institutional level, very detailed. I have something called the Certified Private Wealth Advisor, which is essentially a certification focused on serving the high net worth space. Gets into a lot of tactical things. I have the Retirement Management Advisor certification through the same institute. I like this institute because they do very academically rigorous certifications. That one is especially obviously for retirement. I actually serve on the committee that has refreshed the entire curriculum for that. So I've been blessed to take part in that. And I've taught the concepts that we talk about here for over 2 decades. So that's from an educational standpoint, my pedigree going back, 20 plus years. Now let's talk about practical experience. Because theoretical experience through certifications and education and writing and thinking is really important, but I think it's also important to have practical experience. So I'm going to give you a brief history. Man, it's been a long time ago. I think I went back and looked at finra.org under brokerage check to see when I was registered. And I was registered as a broker July 31st, 1991. So from 91 to 98, I worked for a very small brokerage house for too long, honestly, and I traded technology stocks for retail clients. It was a crazy time. I didn't know what I was doing. I had mentors that were basically stock traders, and that's how I learned. And that became very unfulfilling internally, although it was very satisfying financially. So in 1998, I moved to Payne Weber, which became UBS. And I was there from 1998 to 2003. And that's when I got a lot of my certifications and was growing up in the business and thought that was how it should be done. And quickly became disillusioned with the large financial institutions. Not that they're bad or that there were bad people there. It just wasn't for me. So in 2003, I started an independent firm with two partners, originally called Whitney, Wetzel, and Cuther. And from 2003 to 2019, we built that firm up to, 12, 13 people. And along the way, I started the podcast. And then in 2019, I helped that firm get acquired because I was leaving that firm to focus on my current firm, Agile Retirement Management, because I was focused on retirement. This has been my mastery journey for 20 plus years now. So that's my pedigree from just a resume standpoint. The reason I want to talk about that, or at least help remind you or understand that, so you can make a decision and understand where I come from in my opinions, is I have a lot of practical experience in actually doing this day by day. I've been through the dot-com bust when the NASDAQ was lost about 78% from its peak. I've been through 2001 when the market was closed for about a week and we had a war. Asian crisis in 1998, global financial crisis in 2007, European debt crisis in 2010, global pandemic. During that entire time, I walked life with individual clients, navigating these within the context of their individual plan for either growing assets or retiring or living in retirement successfully, walking hand in hand with them. Those are the external things that I've worked or have practical experience navigating with individuals. So that informs a lot of my opinions. I don't really care what a spreadsheet says or a theory says as much, or I have a better appreciation for life on the ground within those. But I think just as important from a perspective and practical experience standpoint, I've walked life with clients before and in retirement where there was a premature death of a loved one, whether it was a child or a spouse. I've walked that journey. I've walked the journey of people that needed to financially and emotionally help loved ones. I've walked the journey with clients that have gotten divorced older, gray divorce. I've walked journeys with clients that have had very amicable divorces, as well as very messy divorces. And I've walked life with late marriages where you have two things coming together. Practical experience there, unexpected layoff, serious illnesses, investment mistakes, bad investments, overreaction, too much risk, social security decisions, all things that I've dealt with practically, either helping them navigate it or cleaning up things that have happened. I tell you this only to tell you that I have a great appreciation for the education, but a lot of my opinions are formed from actually doing this with individuals and seeing the messy part of managing as all this uncertainty unfolds. So that's the perspective I try to bring, or wisdom, hopefully, from learning and being better at it to you to help you take little baby steps towards rocking retirement. Okay, we're going to continue our segment on reading the flight log from my grandfather and the missions he flew in World War II in a B-17 Flying Fortress. We are on missions 33 and 34. Before I read these missions, though, I want to comment on an email. Actually, it was in our survey about someone that didn't really like me reading these in the sense of it glorifying war and his role in it. And I think that's important to address in that reading these are celebrating his journey of doing this. My grandfather never actually talked about any of this stuff. He was very private about it. I don't know if he was proud of his service or not. I don't know how he felt and the connections he had to the bombs that were dropped on people that killed people. I don't think he glorified any of this stuff. And it's important to remember what's on the other end of this in any kind of conflict. And I think that's a valid point, and I appreciate somebody giving that perspective. So I read this not to glorify war, but to share his experience as a participant in something he didn't really want to do. He wanted to be home with his newborn grandbaby, my mom, but did this in the service of his country. So missions 3334, August 22nd, ship number 274, sortie 22. This one's pretty short and sweet. This is over Ortotol, Germany. Was our target today. As usual, went after an oil refinery. Target demolished. Flak was heavy and fairly accurate. Lucky again, he says. P-51s and 38s were escort, carried 16 250-pound bombs. Mission 7 hours, 45 minutes. Altitude 27,600 feet. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance reference is historical and does not guarantee future results. All indices are unmanaged and cannot be invested in directly. Make sure you consult your legal, tax, or financial advisor before making any decisions.